Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hurricane season opened 2 hours ago. The threat to your portfolio isn't on the forecast map like it's the renewal letter that hit last week. A Tampa duplex that ran $3,500 in insurance in 2022 is renewing at $8,500 this summer. $5,000 more, 3 years. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. The math at the mailbox. So let me walk one deal. And the spoken form numbers are the math you should run on your own duplex tonight. Tampa duplex, 2022 purchase, $385,000, 20% down, conventional 30-year at 5.85. Both units rented, gross rents $3,400 a month, $40,008 a year. Insurance line, $3,500. Property tax $6,001. Reserves and management, another $7,000. Total operating expenses, $16,842. About 41% of gross. NOAA came in just shy of $24,000. Annual principal and interest, $21,780. DSCR landed at 1.1, comfortable. Underwriter didn't flinch, now 2026. Same property, same paperwork. The renewal letter from the insurer comes in at $8,500. That's $708 a month, up from $292. Tampa rents haven't moved. It's one of the 11 negative YOI metros. Our pipeline tracked into episode 135, so gross rents stay flat. But operating expenses now run $22,179, 54% of gross. NOI slides to $18,621. Annual P&I is the same $21,780. That's a fixed rate mortgage, the only line that didn't move. DSCR drops from 1.1 down to 0.85, well below 1. The deal pencils on the depreciation tax shield, period, not on operations. And here's the thing. If you already own in Tampa or Houston or Jacksonville, this isn't a sell signal. Refinancing won't pencil at today's rates. The Sun Belt resale market won't pay your asking price either. The actual move is knowing your real number for the next deal you look at, not the one you're locked into. Back in episode 41, we walked the managed stage playbook for individual policies, wind mitigation credits, My Safe Florida Home, the deductible step-up. That episode still works for one property. Today is the conversation at portfolio scale. Here's the part everyone gets wrong about insurance right now. 3 Category 5 hurricanes formed in the Atlantic last year. 60% of all 2025 hurricanes reached Cat 5, the highest share ever recorded. None of them made U.S. landfall, first time in a decade. And Florida Citizens, the state-backed insurer that ballooned to 1.42 million policies in October 2023, just approved an 8.8% rate cut on multiperil policies. First decrease since 2015, takes effect July 1st. Same year, Bankrate ran the true cost of home insurance numbers across all 50 states for the 2023 to 2025 window. Florida actually dropped 9%, about $579 off the average premium. California rose 41% over the same window. Storm state investors lumped both into one risk basket all the way back to 2018. That basket just broke. So why didn't insurance fall everywhere if 2025 missed and Florida's reforms worked? Because insurance doesn't price storms. It prices structure. California's structure cracked at Palisades and Eaton in January 2025, $40 billion in insured loss. The Fair Plan exposure crossed $6 billion. State Farm got a 22% rate increase provisionally approved while the firefighters were still on the ground. Meanwhile, Florida cleaned up its litigation environment. HB 1A and SB 2A from 2022 ended the one-way attorney fee and the post-loss assignment of benefits. Lawsuit volume dropped dramatically. Citizens depopulated from 1.42 million policies down to under 400,000 in 2 years. And it's not just hurricanes. Severe convective storms, hail, wind, tornadoes generated $51 billion in 2025 insured losses. Third straight year above $50 billion. Texas had 180,000 homes hit by 2-inch hail in 2024 alone. Multifamily per-door insurance rose from $502 in 2021 to $777 in 2024, 55% in 3 years. The Sunbelt's storm risk and the Midwest's hail risk and California's fire risk are all converging on the same per-property math. The insurance market is repricing the country's entire risk surface. And it's pricing it geographically, not seasonally. The map you have in your head about where insurance is bad, it's outdated by a year. And it's outdated in opposite directions. 2 rules, 1 decision. Okay. So now what do? 2 rules. 1 for the next deal you look at, 1 for the Florida property you already own. First, the +5 rule. Back in episode 130, when we walked through the 89 to 300 split, I teased a follow-up, the +5 rule for storm state insurance variants. 6 episodes later, here it is. At underwriting time, on any storm state acquisition, add 5 percentage points to your cap rate floor. Normal floor outside storm states is 4%. You demand 9. 5 becomes 10. Same gross rents, but a higher required yield up front to absorb variance you can't predict. Run it on our Tampa duplex, NOI of $24,000. At a 9% floor, max purchase is $266. The buyer paid $385, $120,000 over the +5 rules ceiling. That overpay is what today's renewals are eating. The +5 isn't a prediction. It's a buffer. It would have stopped this deal at the door. Second, and this one is Florida specific, the 20% rule. This one is law, not heuristic. Florida statute says if a private carrier offers you a policy within 20% of your Citizens premium, you cannot stay with Citizens. Mandatory transfer. 30-day window to respond. Ignore the notice and the policy switches automatically. So when you're shopping Florida carriers, the question isn't only what's cheaper, it's whether the gap to a private offer is 20% or less, because if it is, the choice was already made for you by Tallahassee. And one more piece. If your Florida carrier is rated A by Demotech instead of a major rating agency, take that A with a yellow light. Slow down before you commit. Harvard's 2023 study found 1 in 5 Demotech-rated Florida insurers became insolvent while still holding an A rating. The Senate opened a probe last December from Demotech, and A may not mean what you think. Expand investors. Tonight, pull the last 12 months of insurance bills on every property you own. Then run what I'll call stress test plus 25. Assume next year's renewal lands 25% higher than today's, then rerun DSCR. Anything that breaks below 1 in that scenario is the property that needs a decision this year, not next. Then what? Get 1 comparison quote from a broker who actually specializes in your state, not the agent who wrote your original policy. If you're in Florida, get a Citizens quote and a private quote at the same time, and check the 20% rule before you assume you have a choice. Don't wait for the renewal letter to land. By the time it shows up, you're already negotiating from behind. Get the comparison quote a month before your renewal date. That's when you have any leverage at all. Friday on the blog, we're running the full portfolio stress test framework, the +5 rule plug straight in. This is Martin Maxwell. Prime investors. Pull the bills. Know your real number before the renewal does.